य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्लं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैता 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 एतद्वैता.
I'd like to request C.A. Sanjeev Aditya to rise, to occupy the dais. Today we have the privilege of having with us an esteemed professional whose vast experience and insights will undoubtedly add immense value to our session. It is an honor to introduce Mr. Sanjeev Aditya, a distinguished chartered accountant with over 17 years of experience in the financial and regulatory domain. He is a DISA qualified fellow chartered accountant of our institute. Currently serving as a registered valuer, Mr. Sanjeev Aditya has extensive experience working with listed entities, public sector banks and cryptocurrency exchanges. His expertise also extends to appellate tribunal representations, consulting on accounting and taxation matters, particularly in the BFSI sector. Apart from his professional engagements, he is an expert panel member of ICAI, actively contributing to the profession's knowledge pool. A passionate orator, Mr. Aditya has presented papers on various subjects, enlightening diverse audience with his expertise and deep understanding of financial regulations. Without further ado, let us welcome Mr. Sanjeev Aditya to share his valuable insights with us. I would like to request C.A. Raghuraman to present the memento to the speaker. Over to the speaker.
Good afternoon all, and thank you all for coming in this evening and encouraging the speaker. Though in limited numbers, I'm definitely awed by the fact that you all have taken the time out today and come and sit through this program. I will do my sincere best in sharing with you all whatever I have learned from my limited experience in handling AQMM in these last 24 months. Pretty sure anything that I share here will, in the context of making this profession and our services to our clients better, will help to the extent it's possible. I was very surprised when ICAI came up with this topic. It was, more like trend. So AQMM is in trend thanks to all the the global things that are happening around the accounting profession, thanks to events like OCOA, OFA, and so many of these global events happening in India, and the Indian accounting diaspora getting itself exposed to what's like it in the outside world, right? It's not something new for the global accounting profession at large. The AQMM was something called ISQM, SQMM, SQM 2.0, and in various versions like Shankar's movie, it was earlier being telecasted across various accounting screens of various accounting bodies throughout the world. As such, this accounting maturity model, accountancy firms maturity model, is at least 2.5 decades old in the global context. In an Indian context, as usual, like we took our own time to kind of adapt to it, because our ecosystem has its own challenges in adopting an well-defined structure, because the clients are different, the expectations of clients are different, the investor community, the stakeholders are very different, and we as professionals, we ourselves are also very different, right? So it took a lot of time for our alma mater to come up and adopt to this audit quality maturity model. Audit quality maturity model 1.0 to 2.0, which is something that we will discuss briefly in today's session. But at large, if we can understand AQMM is in more than more easier way that we all understand our entities, it is just like an ISO certification for an accounting firm, right? In more like how do you govern a body is what comes out of this AQMM when you read through the length and breadth of the implementation guide issued by ICAI. When we started implementing AQMM in our firm, a lot of revelation did come out. It is not something like it just reproduces whatever is done by the firm. It kind of ring fences a lot of insecurities that professional chartered accountants, especially the Indian professional chartered accountants, have started to have in the last decade or so, right? We as practicing chartered accountants in this ecosystem are very, very comfortable with tax practice because we feel it is something that's very much within our hands, and we need to go meet the officers, explain them the case, and should we have the fortune of having a good officer on one side and good case on another side, we have an happy day. If either of it is not good, God won't be kind to us in those days. So that's how it has happened for a very long time. Of late, with faceless and things coming in, the tax practice has also is not as charmful as what it was a decade plus or so before. Audit has always been an stepmotherly treatment given by a lot of professionals that awakens during the month of March when the bank branch audit panel comes out, and suddenly again in the month of July, August or September when the tax audit comes out, right? So assurance and core audit as a practice, a lot of professional chartered accountants are not as comfortable as it could be, purely because of the wrath that is created around the fact that audit is very risky. The regulators are always looking. You may suddenly have to lose your practice. Disciplinary proceedings come in heavy and hard when it comes to audit. You will need to build up a big team to be able to do an audit. The client's expectations are different. They'll only go to the bigger names in the town. So like this, there are enough reasons that have been put forth to us as professional chartered accountants to not take up audits, right? Just like auditing was never considered a favorite subject at the time of studying CA in addition to the IT subject. Same way, doing a core statutory audit is not something that's seen very comfortable. On one side, as professionals, we are hesitating to take up big audits. Another side, the clients are also very skeptical on giving the audits to professional chartered accountants. They are like, no, this audit report should speak for itself. The bank should be able to accept. The future investor should be able to accept. If it is a very small company, we are not interested to audit. If it is a very big company, they are not interested to give the audit. So in either ways, we are not able to do the audit. So that is what is happening in the audit world when we go across and understand. Though all of us sitting in this room might be much different, we'll definitely be having a lot of experience and exposure, and more importantly, opportunities to try our skills in auditing. But largely, auditing is not considered more an comfortable ecosystem. Now, is it very typical to our country? No. It's so globally that pushed the Western world to start thinking that no longer audit should be compulsory. Compulsory in so audits are no longer compulsory in larger part of the Western world. Whenever an audit happens, it happens with a lot of seriousness. It is not taken as an tick off a box kind of an exercise. Audit, whenever it happens in the outside world, are taken very, very, very seriously, meaning preparation of financials and doing the audit is no longer done by same person. Client understands its seriousness. They understand confirmation as a strategy exists in the world, right? They don't think signing in right hand and signing in left hand is same. So which means the consciousness from the client side increases whenever there is an audit. Same way, the audit firms are also very different when it comes to doing an audit. I'm pretty sure in the sequence of events that have been happening in the last 10 to 14 years in our own ecosystems auditing profession, moving from the auditing and assurance standard, which was more like an philosophy which people were expected to understand but were never expected to deliver out of it. From there, we moved into something called standards on auditing, which were way more structured, and in a lot of instances were able to guide the professionals more specific to the case in hand through the appendix that started coming in. To a lot of us who have had the opportunity of going through the essays, the essay will be like 8 or 10 pages, but the appendix will be like 25-30 pages. Meaning the appendix now throw more light into the standards, giving the much needed acumen for us as chartered accountants to be able to use that weapon whenever it is needed. Meaning, like when we say no, if we don't get an response from the bank, then we may have to do additional procedure, and if it does not satisfy, we will have to qualify. Sir, enga solrike, where is it given? This is the common thing with the clients when it comes to confrontation. Now, our earlier auditing standard, if we show them, we ourselves will not be able to show them where it is shown, because it was that kind of a text. Now, today's standards on auditing, if you go somewhere, read in the appendix, it will mention instances, what is meant by alternate audit procedure. What if alternate audit procedure also does not satisfy? Which means, today the standards on auditing are going in the direction of codification. I wouldn't yet say it is fully codified. It is going in the direction of codification. And us all, as professionals, are also moving in the direction of codifying the concept of auditing, creating the much needed pattern, much needed process, much needed sequence for us to understand audit and increase our capability to do the audit much better. I used to tell this almost every single time we have this comparison of an auditor vis-a-vis an auditor, a real auditor vis-a-vis the auditor. We all, as professionals sitting in this room, assuming you take up a financial statement and you observe that, in verifying the gratuity valuation related disclosure, two numbers are expected to tally and they don't tally. Everyone in this room will touch your heart and automatically say that that is unacceptable, and you'll go to the roots to ensure that every single number ties. We'll not stop there. We'll go to the 43B disclosure. We'll ensure it is also correct. We'll go to our 3CD, ensure that the disclosure there is also correct. All this for the client's joy. The financial statement, which is the responsibility of the management. Now come back and check, okay, when you are depending on an external valuer who is the management's valuation expert, have we followed the procedure that is given in the standard? Have we independently communicated to the valuer? No, okay sir, client won't cheat us sir. So which means our efforts when it comes to an audit, 95% goes in making the accounts absolutely perfect. We put our efforts in ensuring even to the last point the costing and totaling is taken care, all the notes tie up, all the numbers are correct, everything speaks for itself. But when we go back and check whether we have audited properly, out of like 20 plus points in Caro, do we have proper documentation for every single item in Caro? More often than not, the response will be, I will take an MRL sir, or it's okay sir, next year I will take it together sir. Which means as auditors, we are very clear, especially this part of the, this country as whole, more important this part of the country, the consciousness towards the fact that the account should not have even a single mistake has been enormously high. And should the smallest mistake come, we take it as a disgrace. Oh my God, what I have done. But converse, when we go into an audit and should a peer reviewer or a QRB find that there is a documentary lapse, we will have hundreds of reasons. Today it is easy to find fault. That day on 28th September, who knows? It was not so easy and all. For us to complete the audit and file the ITR before 30th September itself was impossible. Meaning, to complete our work properly, we have 100 excuses. But to complete the client's work properly, we are okay to stay till 2 a.m., 3 a.m., put in the accounts together properly, checking whether the board note and this tallies, this and that tallies, and so many things, right? That culture in this last decade is slowly shifting. Much as any culture takes its own time to change, that culture is changing, where auditors are slowly starting to give a pushback to the client side and say, no, we cannot do this, we need this. No, what authority is making us do it? Thanks to this ICAI and our alma mater in kind of putting together the regulatory expectations and requirements in the form of standards on auditing. There is a QRB, there is a peer reviewer. Now there is a giant in NAFRA sitting on top of all of this, coming and fostering the fact that as auditors, do your role as auditors. Now when we are now being policed heavily, then comes the conscious outburst that we need to take care of audit also equally seriously. And then comes look up into global practices. Then comes look up into ISQM, SQM 2.0, SQM 1.0, SQM, converting it into our child, renaming it as AQMM, and giving birth to the phenomena, expecting the Indian, chartered accountants to start complying it. So, which means AQMM, had it been issued 15 years before, it would have been seen as how IFRS was seen. So IFRS was seen as something that is not relevant to the Indian ecosystem. But in a slow manner, a small changes in accounting standards, then a marriage between IFRS and EAS gave birth to Ind AS. Slowly Ind AS was given as an small pill by introducing in bigger companies, then subsidiaries of bigger companies, then reducing the limit. Now, Ind AS, yes, Ind AS is something people are very much able to comprehend and understand. Same way, in like maybe in another half a decade, people will start understanding and accepting this audit quality maturity model and how it is very, very critical from an practicing chartered accountant's shoes to enable them to do an audit with utmost due care and with absolute authenticity with which the ICAI wants. In mine and my firm's limited experience in handling the disciplinary committee / CBI, CVC and NAFRA, we were very happy with the fact how regulators see. Though the newspapers kind of sensitize every single news that comes by them, the fact is very different. When we go out there, when we have to face the regulators, only thing that is expected out of them is you are expected to do this, showcase to me that you have done it. That's all. They don't ask anything beyond. They don't ask anything beyond the dotted line that are there in our textbooks. All they expect is this was told to you, have you done? If there is something that is not told to you and you have not done, we are not expecting you to do it. I can put in some simple examples, like say guidance note on audit of banks. When you are going and doing an audit, assuming a loan is being given for an project, say for getting ready a toll road, and in the toll road it is observed that that land is already being used by the government for some horticulture project. Now that has come in and the project has been given, right? Ultimately the project fails. Now somewhere someone pulls up and say, how come it passed the test of audit? This land was never permitted for toll. No one found out, the auditors did not find out. What are the auditors doing? Because it is a logical conclusion now. Why was yesterday Sunday? It was Sunday. Why did auditors did not find out? Today auditors did not find out is an normal talk of the town. Now when it comes to that, all that is expected out of it is go to the guidance note on audit of banks. There is a specific segment called audit of advances. In that there is a specific segment called audit of project loans. In the audit of project loans, to what extent is an auditor's expectation to verify the veracity of the loan that is being sanctioned? Now if you go there, it will be very clear that you are not expected to verify the veracity of the loan and the documents and the authenticity of the documents with which it is given. Unlike in some other cases, unlike say audit of a revenue transaction, you are expected to be skeptical that the document itself will be fraud. If you compare these two, you will observe that in an audit guidance note on audit of banks, the veracity and the expectation is much different. Now this is what I was trying to tell earlier. When we do our audit, if only we align with the expectations of our regulators, which is ICAI and its guidance note and standards on auditing, we will be in a much better position to do two things. One, do our work properly, meaning not going through all random places, beating around the bush, trying to find out all unnecessary documents, have a more structured way of doing the audit. More importantly, be in a position to respond to the regulators whenever being questioned. At some point in the maturity of an audit, all that an audit exercise will happen is expectations, complaints. Expectations, complaints. Might look like a checklist style of working, but honestly it is not checklist. It is probing questions on one side as to do this, have you seen this, have you looked at this, is this being taken care, and the complaints on the other side. Now these probing questions gives the much needed skepticism and much needed 360-degree view behind doing an audit, and the complaints gives the much needed confidence and satisfaction behind doing an audit. If at all you ask me what is this whole AQMM trying to do, AQMM is trying to do this only. Right? AQMM we will anyways be discussing. Of course, we have good 2 hours ahead of us to discuss it in more detail, which we will be discussing part by part. But as and when we discuss, we will start understanding and appreciating this fact that all that AQMM has done by its recital is AQMM has created the much needed sequence, the much needed pattern, and much needed circumference within which CA or a CA firm or an organization should operate. Of course, I have immediately heard comments we were part of the groups which were heavily involved in creating this AQMM by seeing the global practices and all. We did hear immediate rebuttal from the market saying, anyways it is for big firms only, not for us. It is like we'll start with big firms, then it will become medium firms, then it will become individual practitioners. Of course, it is also even now applicable for individual practitioners, but it will start reducing the bar in terms of its compliance, because more than targeting by individual I mean more than targeting the professionals, this is expected to target the profession as a whole, meaning a chartered accountant firm / an auditor from India will do an audit under an ecosystem called audit quality maturity model. That is the level at which the bar and expectation on how to run a firm, I mean how to run a professional firm, is getting pushed. So today, over the next 2+ hours or till whatever time you all and I get bored, we'll keep going through different parts of this AQMM. Wherever we feel it needs a bit more deliberation, a bit more understanding as to why at all it is there. Sometimes if we start reading the jargon, we'll start understanding idukku namukku sambandhame illiya, we would have never done something like that in our past, and we may not do something like that in our future unless we understand what it is about today. And when we deal with that part is where we will try to touch upon bank audit as an example, because technically AQMM has nothing to do anything with the bank audit unilaterally. AQMM is an overall concept. It is applicable to a bank audit, an insurance company audit, a listed company audit, technically any audit. It is more for how to run a firm, how to run a professional office. That's what AQMM is about. So I only immediately call whoever put the topic name. In fact, the topic was much different before. They wanted to say, sir, bank audit le AQMM. So bank audit le AQMM mudiyadunga, AQMM la da bank audit mudiyum. Then they kind of changed, and they wanted me to explore a bit more by giving practical examples in bank audit, which kind of makes sense. Introduction to AQMM, comparison with AQMM 1.0, the scoring system, its applicability and its relevance and level, detailed breakdown of the AQMM, which is, there will be 3 parts. The part A is regarding the practice management, part B human resource, and part C monitoring evaluation, which is the digital competency. We will typically be going through 2 slides, I mean 2 set of deck today. One deck which is not relevant, which is what I prepared. The other deck, which is something the ICAI themselves have released as a part of the Center for Audit Quality Development, CAQD. There is a very brilliant deck which the which the leadership has published, which is what we will be seeing today. That's also one very brilliant thing that our institute has started to do now. Same topic called AQMM is going to be dealt by at least 150 to 200 different people between like 2 months before for another 8 or 9 months in various forums. If at all of us speakers go and create a deck for AQMM so many different times in so many different variants, it might not be appropriate. So ICAI has come out with an initiative in giving out a deck by itself, which the speakers and largely the general public and the professionals can use by themselves. So today the core part of whatever we are going to see is already available in the public domain in the institute's own website, where we can go and pick out what this AQMM is about. I think we would only go there straight. So I'll only be taking to the critical parts. I wouldn't really go through the advertisement for ICAI. Okay. So this AQMM 1.0 and 2.0 is just like AQMM 1.0 in itself had a very short lifetime. It was there only for like 18 to 24 months, and suddenly 2.0 came, which means it is not technically a next version. It's just an upgrade of the existing version of AQMM. So this is what the scoring pattern about AQMM is. There are 3 sections in the current AQMM 2.0: practice management assurance, human resource management, and digital competency. Before getting into the score and percentage, what AQMM has done, as I already explained, it has now created a boundary on how a firm should operate, which means if someone reads AQMM and tries to apply, they will end up putting together the SOP for their practice, putting together the organizational chart, putting together the digital framework, and use AQMM as the guiding document behind how the firm should be run. Now each firm renames this AQMM and its compliance in its own way, and the way it kind of suits and it can be used by it. So typically the start point of creation of this AQMM document for your respective firms would be to rub everything that is already there in terms of practices, start things up scratch, right? Then as and when we go, should there be practices that are already there in our firm, take that and marry it with the expectations of AQMM. What happens? A redundancy can get created at the leadership level. Once a framework is done, once the processes are set, once the checklist and formats and everything is set, the expectation for the partner to be there at the audit need not always be there. Of course, all the senior professionals here who are in practice will definitely appreciate a fact. More often than not, our audits are completed good because of our presence. And if our articles are manager and we expect them to do good work, they do a brilliant work, but that last mile is ultimately pushed by us, because they tend to miss something, or they tend to have not found something which our eyes can find, despite the fact that they spend 90% of the total time spent in the audit, and that 10% time which we spend typically would have added that 90% of the value and 90% of the correctness in the financial statement. Two reasons: one, our vast experience with the client, with the profession and everything, but at the bottom of our heart there is always a feeling that we did not guide them properly. Had we told them this on day one, example, fixed assets verification, we will allot to someone, day fixed assets pathra, you see the fixed assets verification, he will also mangan okande, he will do a ticking of all the additions and everything, and when it comes to us, we will ask GST input edutana, that's all. He will be flabbergasted, he will be like, GST ya, because he did not imagine that this was the question paper. He came to same ICAI exam only, no, he did not expect this will be the question from the partner. Sir, GST input, sir, you asked me to tick addition, sir, you didn't tell about input. Hey, when you're ticking addition, automatically whether input is eligible or not is something you have to see, asking today, see, and all is okay, but 20 days he has been seeing fixed assets additions for a huge project addition. Now going and asking him whether GST input is taken is neither useful to you nor useful to him. But think of it this way: what if your firm has a ready-made document which guides your person to understand, oh okay, audit of property, plant and equipment, do these things, expect these surprises, right? Now that is what gets achieved in AQMM, which means it goes beyond just a framework, it becomes an SOP to do every part of the work. Why are you coming at 10:30 in the morning? Why didn't you come at 10? Sir, no one told me the office timing, sir, I came for the interview, sir. Or they'll come at 9:30 even before our office boy comes. Sir, I came at 9:30 itself, sir. Why? Because there is no standard document, standard place which people can look up and understand. What we will think, we have some seniors in the office, they will educate them. What will the seniors think? The partner would have told during the interview. So which means everyone will keep thinking and imagining and expecting only, but nothing will happen. Now on one side, expectation on the audit, on the other side, expectation in office management, all these things are subsumed in an AQMM. AQMM typically starting from whether should to wear a laced shoe or a cut shoe, to the fact of how to qualify in an audit report and what are the kind of words that are to be used in qualification. That is the vastness in which this AQMM covers the way a firm governs itself. Now getting back into the scoring mechanism, typically whatever we will now be discussing in AQMM, the practice management assurance, which is how you do your work, right? That how you do your work in so many dimensions and combinations is getting discussed there. The human resource management, which how do you handle your human resource, which again we will be seeing, though I cannot link it with bank audit because it is an overarching phenomena. It kinds of tells you, okay, if you are an organization of this type, then this is the kind of human resource management practices you need to have. Then the digital competency. In today's world and environment, even us as CA firms can no longer expect to take 1+1 copy print, check the original with the Xerox and see if our Xerox machine is working properly. So the expectation on the digital competency and the way a firm has evolved in terms of its capability to carry out its work in the current day's context has become pretty much relevant. Earlier it was practice management operations, human resource management, practice management strategic or functional. That was found, I don't think it was found irrelevant. This has now got subsumed into different parts into the 2.0. The strategy and function was more like what is the firm's vision, mission and objectives, how does the firm expect to see itself in the next 10 years, next year in the next 10 years. Like this, the strategy and vision were more at a top level. That has kind now subsumed into the practice management assurance part of the AQMM. Now these are the minimum marks. I think let us not be worried so much about the marks here. Now these are the concept of level at which the firms are being categorized based on what they have scored. Level 1 firm less than 50, level 2 firm less than 70, level 3 firm less than 85, level 4 firm less than 100. Typically based on whichever band you form, the maturity of the firm is being understood. Now there are two ways in which this can be monitored. One's a self-monitoring thing. Of course, institute has also much progressed in its digital competency. Now if you go to institute website, there is a ready-made calculator where you can put all the points, where it will add things and tell what level you are. So which means you can identify through a self-evaluation as to which part of the band are you. Plus any firm who is getting peer reviewed, I think ever since the last cycle, have to mandatorily get themselves also valued for AQMM, right? So which means whenever your next peer review, or if you already done your peer review recent past, you would have gone through this exercise of AQMM. Going forward, every peer review, one of the mandatory things that your peer reviewer will start seeing into you is AQMM. Other way around, if you are a peer reviewer, you will have to go and see the AQMM into the firms that you are looking into. So this is what I was saying. Sooner or later AQMM will become a mandate for you. Now if you look at it this way, AQMM has been made mandatory from 1423 to the firms auditing the following entities: listed entity, banks, insurance company. So which means if you want to do a listed entity, a bank at a central audit level, a bank branch audit is yet to get, only bank branch audit is yet to get covered. Insurance companies, right? Level of the firm obtained using, so this cannot be, it is not though it is like an ISO, it is not an ISO. So you cannot go put it on your website saying that I am a grade 4 firm, I am a grade 2 firm, because AQMM itself has an QMM. This AQMM has not yet matured for us to go out and say to the world that this is my maturity level. So you cannot advertise the fact of your grade, right? In AQMM 2.0, the same 1.0 is only continuing. The future of AQMM is going to be something like this. Kind of informal, but I think to our own fellow professionals we can share. NAFRA will start coming out with a chart saying this is the firm name, this is the level of maturity, and sooner or later when the entire appointment of auditing no longer will be rigged and will be an open floor to dance, people will start looking at the NAFRA site to understand which firm is at which maturity level, what are the kind of plus and minus about this firm, and do an independent pick out of the firms. That is the vision. Now has it happened elsewhere? Yes. If you go in the US and you start auditing a listed entity, there is an NAFRA picks out its cues from a body called Public Company Accounting and Oversight Body, PCAOB. If you go to the PCAOB website and type the firm's names, it will actually give all the reports issued against the firm by the PCAOB, all those things. So which means any issuer, which means the listed entity in the US, for them to pick out an audit, they go to this PCAOB platform, they identify the history, geography, botany, zoology of the firm, and only then they come to the firm. So the Kundalini of the firm is already there in the PCAOB website. This is where the Indian context will also move, where the entire firm's stuffs will be available in the NAFRA portal, where they will officially publish that this is the maturity model of the firm. So that is the progression with which we all are going. Yeah. So section 1 is the practice management area. So we will pick up critical areas. We will not pick up a whole lot of items that are there in the AQMM. We will pick up critical areas, dwell deep into it, touch upon bank audit wherever it is relevant. Practice areas of the firm: workflows and practice manual, service delivery effort monitoring, quality control for engagements, client sensitization, regulatory compliances, practice management, strategic and functional, which was there as a separate part in the earlier model, has come inside as a part of practice management assurance. The infrastructure, practice credentials, presence and implementations of formats of checklist or templates. You will observe like almost 90% of the points comes from the so-called checklist blah blah blah, which is the real on-field application of audit. Everything I read out earlier are kind of things that stands in the peripheral. They are not the on-field things, but only if those peripheral things are there, the on-field things will sustain, right? So we'll go into the formats and checklist. I think that is where the whole relevance will be. Okay. So the first time in the history of institute, also I would say, they have come out very clearly what is the kind of checklist and documentation that you have. Earlier also there were so many such guidance note of audit, this, that, so many things that used to come. In fact, I also still remember when we used to get an opportunity to hear two speakers, and we also get an opportunity to speak. More often than not, one question will be, sir, idella right, naanga enna panano. What is it that we need to prepare? Is there a format? Is there a checklist? Is there a requirement as to for what we need to have a checklist? Has always been the question, right? Now, through this audit quality maturity model, what has been achieved by ICAI is they have put together a list of items or checklists or formats that are typically needed by you in the context of carrying out an audit. So today we will now spend a lot of time in understanding each of these documents in the context of why, what and how, and try to some extent match that with the background of bank audit and see how we can imagine or visualize that document, right? So that is what will be our objective in terms of our discussion today. The first of the templates that is expected is client acceptance, continuance and appointment formalities. Just before I get into this document, now you should understand this AQMM is at a firm level. I am just trying to reiterate and bring things into context again. AQMM is at the firm level. At the firm level, you are expected to have a lot of structures, protocols, blah blah blah. In that, you are expected to maintain a set of templates and checklists which can get used throughout the firm, not specific to an engagement, not specific to a partner, not specific to a manager, because our kind of functioning here, what is now formally called as network, is something we have been following for a very long time here. 5 or 6 people coming together in forming a firm and help pitch bigger audits, but each of these firms will be independent in terms of its operations, right? The so-called network architecture. Now when we are adopting this AQMM, it has to be pan firms. If you and your fellow friends are working together in a single brand name, or you all are working together in one very old firm's brand name, it is very important that these kinds of formats and checklists are adopted across all the branches of the firm, and it is not like only one person or one audit, or more importantly, it is not like, sir, I have 20 audits, sir, only 2 are very good audits, rest all are not good audits, I will apply it for only 2 audits. It is not like that. These are things that is applicable at the firm level. Now having said, the intensity at which these forms get adopted can vary across audits. If you have an listed company audit, the intensity of this application vis-a-vis you have a very very small retail company with whom you are doing only a tax audit, the intensity at which these two are done can be much different, but the framework is common across all the audits. So now when we are discussing checklist, let us not convex our thoughts into a single audit or a single assignment. We will think of it at the firm level. The first is client acceptance, continuance and appointment formalities. We were also stunned by the fact that something like this existed. More often than not, our size and our age of firms, clients come in. Client coming in itself is a very big thing. Now if I have to do a due diligence when a client comes in, and I have to accept only if a client is good, right, then you can only imagine where we are pushing ourselves. We are only making our packets burn even more heavier. But the requirement is, whenever this is a requirement of standards on quality control, SQC1, the future SQM1, right? There is SQM1 and SQM1 and 2 that has got released and which is effective 1/4/2026. The requirement is, whenever a firm accepts a client, not only accepts, whenever it continues with the client, it is expected to confirm that it is okay to accept the client or confirm the client. Now what do I mean by this, sir? You are reading the same thing in active voice and passive voice. What do we mean by this? It is typically like this, right? So sir is an auditor, I am a client, maybe I am due for rotation because I have bank borrowing of more than 50 crores or whatever reason. Now I come to sir and say, sir, my current auditors are XY and Co limited, XY and Co firm. I want a change in auditors because of so and so reason. Will your firm be interested? Our normal thing is, yes, take the consent letter. What date you want the consent letter? Yesterday's date. Take the consent letter, give me the audit. That is our current mindset. But the future requirement is not like that. No. Okay, you have come in the Vechigo. Take this checklist. Now tell me who you are, where is your address, what is the business in which you are functioning, who are the directors of the company, who are the key managerial personnel, who are the major shareholders of the company, has there been any case against you, sir? Has there been any case against the promoters, sir? Overall, sir, has there been any case against the directors? Which means you need to do an investigation into the client and the client's affairs even before nodding your head. That is the client acceptance. We are yet to go into engagement acceptance. We are currently at the client acceptance, meaning whether you can let him inside your office. We are now at that level. At that level itself, you need to do some amount of due diligence about who the person is, who the company is, who are the major shareholders, what is the background verification of them, what good things they are doing, what bad things they are doing, and if they are doing any bad things and if their name is in the news already, know what it is and understand what is the issue. The immediate resistance that I get whenever I speak is, sir, if he is a fraud, should I not accept the audit? If he is a fraud, I should accept the audit. Tell me yes or no. The answer is nothing prohibits auditors from taking clients who are unfortunately fraudulent, because we have been given weapon in our hand to handle the fraud creeping into the financial statement. We can qualify the report, we can give an EOM, we can draw an adverse remark, we can do whatever we want. But the problem is when we get into an engagement without understanding the fact that he is a problem, right? So that is where this client acceptance comes, which means your firm is expected to have a standard template or a questionnaire which our teams will fill as a part of the KYC document. Typical practice would be to know the names of the promoters, key managerial personnels, shareholders, major shareholders, etc. Do a Google search with typical syntax like name of the person, Sanjeev Aditya, director of ABC Company Limited, fraud, embezzlement, CBI, CVC, forgery. Put all these words with asterisk. So Google has an excellent feature where it will map all the syntax. It will go back, match all the syntax and give all the news where my name has come with any of this in unity or in combination. Okay, so you go through all of it, you understand that there has been a fraud, that has been case filed against me, my name is in the news for good or bad. You understand everything, you complete your client onboarding, right? So this is client onboarding. Then comes engagement acceptance. This is slightly different. Now client onboarding on one side is about accepting the fact that the client can come in. Then comes engagement acceptance, where you go further deeper, meaning whether this company is capable of preparing its own accounts, the way he talks, do you think they will be having aggressive accounting practice? Say that person comes in, you tell him, okay sir, what is the turnover of the company? 200 nu vechikalam, 300 nu vechikalam. Sir, what will be the average profit? Sir, உங்களுக்கு 20 crores, IT க்கு 10 crores. Sir, what is the stock? நீங்க பாத்தீங்கன்னா 8 கோடி, நாங்க பார்த்தா 32 கோடி. So which means we by default know that company has an habit of defaulting. In your enquiry procedure, in your initial enquiry with the client, do you feel that they are very aggressive? They are very aggressive when it comes to handling the financial statement. Aggressive in a wrong way, right? Sometimes they can be aggressive in a right way. They can say, sir, no sir, we are in the verge of getting our company listed, so we are in a fast track in increasing our revenue, so we are going about making multiple acquisitions now. Or they can say, no sir, we are putting up a lot of new plans now to increase our production capacity, we are entering into new fields, we are doing commodity trading, this, that and all. So which means when you talk and when you keep talking to the client more and more, you tend to understand the integrity, the aggressiveness, the capability, so on and so forth, and put together this as an checklist / a response to those checklists, and come to a fact that okay, this is the company, this person has the capability to hand the accounts. I don't think there is an integrity issue. I don't think they are aggressive in their accounting practice, but they are in the verge of getting listed. They are in the financial institution space. They are highly monitored by the regulators. Like this you write, and then you decide based on all of this. I conclude that this client is an high / low risk client. This engagement is an high or low risk engagement, which means the standard requires that before you even bring in a client, you do enough amount of dusting on him, and you decide whether he is risky to you or not. So this is risk assessment of client at the firm level. Then come risk assessment at the audit level, which we will be discussing separately. After doing this, you come to a conclusion that yeah, okay, he is an high risk or a low risk client. If he is an high risk client, typical question is that if he is a high risk client, should we say no to the engagement? It is not like that. When the client is high risk or the engagement is an high risk engagement, all that is expected out of us is to devise an audit plan or put in sufficient amount of audit members to be able to handle the reasons why which it was an high risk. It is regulatory driven, it is listed company, its employees are not capable of handling the audit, whatever are the reasons you mention to say that the engagement is a high risk. You devise your plan, you put a team in suitable manner that the high risk is being taken care, right? So this is the first template. Now jumping into the context of a bank audit, typically bank audits are a high risk engagement. They are run by regulators, more often than not listed. There is often a rotation of job. There are complex financial transactions. Banks typically have a derivative transaction, they have forwards, futures, so on and so forth. There is always an inclination to do a fraud in terms of a wrong loan being given, lower provisioning being made, and all, right? So in a client acceptance environment for a bank, invariably it is a high risk client and high risk engagement, and invariably you will see the names of those directors, promoters, blah blah blah, appearing in some CBA or a CVC issue, because the nature of industry is like that. So how do we do it? We do a client background check, take screenshots of all that we have seen, put together a template which says Sanjeev, number of issues found out 1, 2, 3, 4, whether this accepts the audit, yes or no. If it accepts, if it affects the audit, then how you are handling. If it does not affect the audit, then there is no problem. So your client engagement acceptance has something called client acceptance, then engagement acceptance, then a background verification. All this put together is the set of template for this stage. Now is this relevant only in the year one? Every year same thing, sir. Last year you confirmed you are not a fraud. Can you confirm this year also you are not a fraud? So every year you do the same thing again. That is what is called the continuance part. So engagement acceptance and continuance test happens at the firm level. Typical architecture is, in a firm there should be something called quality control committee, whatever is the name we want to give, that dictates the tone at top and says this is how it is. Normally the partner who is sourcing the client, or the client, whoever partner he comes, that partner or the team under that partner should prepare this client acceptance and engagement and roll it into this quality control team. It could be a single member or a slightly bigger member depending on the firm size. That quality control team should say, okay, this client accepts to our firm's practices, please go ahead and take. So it cannot be we fill the form and say okay, hence approved. There has to be one another person to whom this client acceptance goes. It is very much okay if it is a single member firm, someone in your firm prepares and you approve. It is not that it is not relevant to more single member firm. Even if it is a single member firm, you can still do it. But same thing in maker and checker should not be the same person. That is the logic here, right? Second one is engagement acceptance, continuance, withdrawals, rejection, decision checklist. One part of it is something I already dealt along with client acceptance. I will deal the second part, withdrawal, rejection, decision checklist. Once there is a sequence for acceptance, there has to be a sequence for rejection also, right? So just like there is a checklist for acceptance and engagement continuance, there has to be something for rejections and withdrawal. It should say, as per my firm's policy, we will not audit companies that deal with liquor because we are more conscious towards the citizens. We will not audit companies that uses biofuels, right? You can decide the kind of withdrawals or rejections, or you can say we will not accept clients where a fraud has been identified. That can be your firm's decision. No one can come and question, but you need to write it up and when the engagement acceptance continuance comes, they should fill this checklist and say, this is our firm's policy on withdrawal and rejection, none of it is applicable in my instance case, right? Second thing is independent confirmation, personnel, firm and non-audit services. I have not faced this to be a very crucial thing in our part of our size of firms and things, because for us அடுத்த வேலை சோறுக்கே பைசா கிடையாது. Where we are going to invest in share market, buy shares of the company and go and do audit of the company in which we have shares, very rare only. But in the context and the interest of the standard, it is something like this. You are expected to be independent of the entity. Financially you have to be independent. You should not have so much of familiarity threat. There are so many threats that our code of ethics discusses about. Typically your firm should dictate what does it mean by independence. Some firms are like, you should not, no one should have shares. Some firms are like, that engagement team should not have shares. Both of it is okay, depending on the extent of confidentiality your firm has. Some firms are very open, everyone can see every audit file. In that case, no one should have shares. Some firms are like, no, if this team, this vertical, this partner, they alone will have access to these files, others won't have. In that case, your policy can be very different. Typically in the context of banks, I think bank themselves will take an approval from you, but in the context of bank, having a loan from the bank is assumed to be a dependent thing. So if you are having a loan with a bank in which you are approaching for a bank audit, you need to ensure that the loan is closed or transferred to some other bank before you accept the engagement. Not independence. There is no conflict of interest is when I do more than one service. In independence is a way, because I have pushing into independence. That's how we can say, exactly, right? So I am interested with that entity because I have a loan from them. So and hence I won't be independent, right? So it is preferred not to have that. More importantly, have a proper documentation around it. Now here very technical arguments that are coming up in the world is, sir, what is the point at which I should see independent? Is it at the start of the audit, or is it at the end of the audit, or is it through the audit, or is it the financial year in which I audited? Answer is always, you need to be independent at the start of the audit, throughout the course of audit, preferably independent for the period for which you audited, which means that 24-25 is the period you are auditing, and you are getting the appointment in say April. Preferred would be that you have been independent throughout 1st April 2024 till the time you are signing the report. So you typically get an independent sign off from your team at the start of the audit, at the end of the audit. Slightly bigger firms, the expectation will be to roll out independence sign offs quarterly, irrespective of whether they are in part of audit or not. Quarterly once rolling out to everyone saying, if shares are there, reduce the salary next time so that they don't buy shares. Take some corrective actions for them to don't creep into the area of independence related issues. But this is very, very strictly viewed by the regulators in larger companies and larger firms context, but something to be varied. A lot of firms don't even have the checklist for independence. That is strict to know. So we need to have an independence checklist that is being done. That is the personnel, firm, non-audit services. So if you have a non-audit team, in fact our code of ethics today, the 2021 revised version is very different. No longer audit and non-audit services are a no. It is not like that. You can do audit and non-audit so long as you don't do a section 144 breach. But when you do an audit and non-audit, as per the code of ethics, you need to follow certain criteria, inform the audit committee, maintain separate teams, have separate leadership. So long as it is there, then audit and non-audit is okay. Audit and non-audit in the nature of familiarity threat, self-review threat is not permitted, which is the section 144 violation. Audit, non-audit normally is not a no-no. Audit, non-audit is okay so long as it is not an breach of section 144. That is the current thing. So that is what your firm will dictate, what kind of services you can take, what you cannot take. Typically in our firm, our size of firms and all, a single list of all clients itself won't be there. Today if we ask, we will have a list. That list will be dated. We may have 2 or 3 branches, each of them will be having one list. None of us know which is the one single consolidated list. Our expectation is at the end of a tax audit season, Winman or whatever software we have, that is the repository of the list of clients that we have. That is not a good practice. Better to have a sanitized client list and ensure an independence confirmation is taken across the entire client as as periodically as possible. Third thing is confidentiality undertakings. Actually, if we read our SA 200 and also the SQCs, confidentiality is a part of the integrity. It is not a separate item. But having said, of late this confidentiality is becoming a very obvious problem, because people are going about and saying every news that they have in their hand. You know what, in that audit, when I was seeing that managing director came and in the last minute he said, profit no, this is an absolute confidential data. It is not something you are expected to go out and discuss. But today, giving viral news is a trend, no? So people will always want to give viral news. So to ensure that there is a confidentiality undertaking, this you need to take from all your staffs. The best way will be when you onboard staff into your office, have a set of checklist, make them sign. Once in 3 months, give them the checklist again, ask them to read and confirm. Slightly able firms can digitize this by having a portal in their website where they periodically go and say yes I confirm, yes I confirm. So depending on where we are in terms of our financial abilities and stuffs, we can decide the model in which we want to do, but the fundamental is to do an periodical independence, confidentiality and undertaking and all. Then the engagement letter. Why engagement letter should become so important part of AQMM? First and all, I used to think it is obvious, but then I understood most of our engagement letters happen over phone itself. Sir, in the fees okay va? This poor sir, okay, done. Work and all will over. Then when the peer reviewer comes, we will say engagement letter is not there. Then we will go find the old letterhead we had, then take print in that old letterhead. To make the paper look old, then we will keep it on some old file, then make the paper look old. Then we will go to the company and we will be surprised by the fact that that staff is not there. Then we will go and find the staff wherever it is, make him sign the engagement letter. All this drama and all happens. To avoid all of this, prevention is better than cure. So better to have this engagement letter done. The simple small tool tips, right? Do an engagement. 5 years, it is an company audits have a 5-year engagement. Tax audits have a perennial. Even after the company dies, even after we die, we will continue to do the tax audit. That's how we have done. Best way is to have one engagement letter that says unless revoked, the terms will continue, and every year send a single line mail saying last year's engagement letter continues. So do one exercise, have the entire repository of clients, create an mail merge option, pull out an engagement letter, sans the clients, send it to everyone, get it, sign and keep it in your file. Have it more like a permanent file than a recurring file. That is the best way to do. That was on a lighter note, but a culture is very important. When we take up an engagement, after signing the engagement letter only, we send the initial details required. In a lot of cases, we will give the final audit report itself before we give the engagement letter. We should not get into such kind of practices. That engagement letter has its sanctity and its sequence and its relevance in the court of law. You can have a standard format. Most advisable way is to have one single engagement letter that covers statutory audit, tax audits, certifications, so that you don't have to run behind putting engagement letters multiple times, because in our country certificates are taken differently. They will call at 8 PM and say, sir, naalik tender ponu sir, urgent or certificate, sir, ipa naalik kaalla podren, sir, nethi rate potu venu sir. So this is how we are giving certificates. No, in that context, if tomorrow morning you have to give an yesterday dated certificate and get an engagement letter 5 days later, to what date you will take? Better is to take it upfront. Take an engagement letter on 1st of April of every year and say these are the services I will be rendering to you. Whether or not you are rendering, God knows. Put all that, get one engagement letter. The fees alone can be agreed upon then and there. You can figure out that way. But the terms of engagement is something you need to do it upfront. Now, immediate question, I think most of you know the answer. Sir, certificate to go engagement letter. Technically, SA 200 is only for audits, assurance of the financial statement, but there is this guidance note on special purpose reports and certificates, which requires you to get an engagement letter for everything that you do, standing, sitting, walking, running, everything. So for you to do anything with the client, you need to have an engagement letter. So that guidance note warrants you to do it. So best way is to create a consolidated engagement letter and roll it across, sign and keep it. Year on year, do a negotiation letter only on the fees or whatever terms we want. Thanks to company said no longer there is an yearly appointment and it is a 5-year appointment. Ratification is also not there. Very comfortably you can do. Unfortunately, in the banks that won't work out, because with banks it is a 3-year appointment within which they cannot send you out, but there is an yearly ratification required by RBI. So which means for banks alone you need to write an yearly engagement letter. In that engagement letter for banks, please be aware to put specifically the set of certificates required by RBI, because RBI warrants 14 or 13 certificates that has to come with the financial statements, that comes out separately, and the other certificates comes out separately. So that has to kind of identified specifically. If you are joint audits in banks, engagement letter will be joint with them. The engagement letter will also have something called a joint responsibility allocation, where the entire financial statement is sliced and diced into multiple parts, and each of the firms is allotted. In compliance they say 299. So this also forms part of engagement letter. You tell the client that we have split amongst us like this. You tell your joint auditor that we both have split like this. Client gives us, of course client is not expected to get involved in a joint responsibility allocation, but he is expected to be aware of who is responsible for what. So all this forms part of your engagement letter. Makes sense to create one single template that kind of takes care of everything. Next one is planning the scope of engagement. Rarely a separate document, more often than not forms part of the engagement letter itself, where you scope in what are all the expected deliveries that you need to have. Typically the sequence, what is the expectation? Okay, this is the expectation, then this is the requirement. If this is the expectation and this is the requirement, this is the amount of efforts. So all the sequence kind of bulks in. So you need to have an interface or an concept of planning the scope of an engagement. Now this throws lights into multiple areas. How do you go about planning? Now planning the audit, if you go, then there is say 300, 315, 330, 350, all these standards compliances are there. Typically for each of these standards we will try to have a separate set of templates, a separate set of environment, and separate set of requirements where everything gets documented. We'll complete the rest and then maybe come back here and see in planning an audit what all is needed. Then budgeting resources and hours, including experts' time and cost. These are okay, these are all more just for the sake of doing it. In our size of audits and context, none of it makes relevance, but you need to typically have something called budgeted hours behind an audit, the actual hours and the cost that is involved. The next comes understanding the client's business, its industry and key people. As if what we did earlier is not enough. Earlier whatever we did during the client onboarding and engagement acceptance is 30% of this stage. Typically this is compliance with SA 315, identifying, understanding the business environment of the company, including its internal control environment, which is the mother of all standards. This is a separate template in itself, where every part of SA 315 should become a question, and in response to every question you need to get an answer. It will start from what is the company, what is the past of the company, who are the current directors, who are the current shareholders, who are the key manager personnel, to whom will you be interacting during the client, what is the business, how many branches, where is the manufacturing facility, who are the competitors, what is the industry trend, what is the financial parameters, does the client by himself perceive any risk, and what do they have an internal audit, what is the technology in which they do the audit, where is the data served. Like this, a lot more detailed document comes out when you do this SA 315 exercise. Typically, a lot of reasons. The example that I told earlier, PPE ki GST input edukliya, and the mari a lot of things get solved when we know the client very well. Oh, okay, you are in the R&D phase, so which means there will be a division called R&D, separate books of accounts called R&D. Oh, okay, you have 4 different verticals. That means segment reporting is relevant to you. Oh, these are your related parties. Okay, related party reporting. Okay, these are the committees you are having. Okay, I need to review these minutes. Which means what all you need to work on in itself comes out when you do the SA 315 work. So that is enormous. In fact, what we understand in the life cycle of an audit is typically 30 to 40% of your audit is spent in this planning phase, and even in that another 25 to 30% of that 30% goes in this SA 315 exercise itself. You do a market research, you go and identify. If you do an NBFC audit, you go and identify what is the NBFC trends, you understand how is the housing finance companies are functioning, how the consumer durable segment is functioning, whether the interest rates are getting lower, interest rates are getting higher, which means you go full throttle into the audit after understanding the industry, the company, its internal control environment. More importantly, I will tell you why internal control environment a bit later. Internal control environment heavily, and get your mindset as to the animal that you are trying to tame. Now, to all of us, this all might not look very relevant in the context of audits that we have been doing for the last 30 years. Sir, என்னை கேட்காம ஜேர்னல் என்ட்ரி கூட போட மாட்டாங்க. அந்த கம்பெனிக்கு போயிட்டு இன்டர்னல் கண்ட்ரோல் என்விரான்மெண்ட் என்ன, உன்னோட ஹையரார்கி என்ன அப்படின்னா சூப்பராக இருக்கும். ஐ திங்க் ஆல் ஆஃப் யூ வுட் ஹேவ் ஃபேஸ்ட் திஸ். யூ ஓப்பன் தி டேலி, புட் நரேஷன் as suggested by auditor, as suggested by auditor, as passed by auditor. So which means there will at least be 40 entries which are the most important entries in the financial statement, and they think it is the auditor's responsibility to pass those entries, right? அந்த கஸ்டம்லேருந்து எங்கே வந்து நம்ம வந்து அண்டர்ஸ்டாண்டிங் தி என்டிட்டி. ஜோக்ஸ் அப்பார்ட், தட் இஸ் தி ஹோல் பர்பஸ். கோ அண்ட் டெல் தி கிளைண்ட், என் பாரு நான் சொல்லி என்ட்ரி போட்டாலும் யூ டோன்ட் ஹேவ் டு டாக்குமெண்ட் தி ஃபேக்ட் தட் நான் தான் சொன்னேன். யூ கேன் வெரி வெல் ரைட் அ ப்ராப்பர் நரேஷன். வாட் யூ வில் சே, சார் அதெல்லாம் தெரிஞ்சால் நான் ஏன் சார் இங்கே இருக்க போகிறேன், அது தெரியாமல் தானே நான் இங்கே இருக்கேன். That is the fate, but then there is also the fact, right, that we need to handle the clients and we need to educate them in such a manner that we are able to fill these documentations properly. Significant applicable laws and regulations, typically in the SA 315 exercise itself, if you go through standards on auditing 315, there is a place which will say what are the applicable laws and regulations of the company. I have seen people writing random acts and all, Child Marriage Act, and Against Women Act, so many things they already. Relevant to financial statement, what are the applicable laws? That is what you are expected to write here, not write laws and regulations which do not have a relevance to the financial statements. Of course, I am not focused at saying financial numbers. In the financial diaspora of the company, what are all relevant? PF, ESA, bonus, gratuity, Factories Act, other labor laws that are relevant, superannuation related benefits, then overtime related legislations, all these things have financial act. But people overwhelmingly go inside and type in Google applicable laws for a company in fertilizer. It will give 177 legislations because there is a total number of live acts in the country. Our person will copy all the 177 and put it inside the file. Now the problem is, how will you do the complaints for this 177 legislations? Anything and everything that you write in this phase of the audit, in the next phase of the audit you need to document complaints of that law. Now if you go and ask the client, sir, there is an act like this, there is the e-waste act, electronic waste monitoring act. If you go and ask the client, sir, in our company computer is like God, we don't destroy computers. Sir, at some point it will become obsolete. No, see sir, all the obsolete computers are here only, we don't do anything to it. Sir, 3 years once you need to file a report to the local corporation, sir, saying this is the e-waste I generated and I am discarding it, sir. Then he will say, oh okay sir, okay, tell me to which office I should do, sir, this corporation office. Then you go to corporation office, they will say, என்னது e-waste என்னது form 4 அதாவது neither the regulator knows nor the company knows. Better for us to identify only those legislations which we can handle, which the client can understand, which we can document. Typically the finance and labor laws related legislations, document it in depth. More importantly, check for complaints with those legislations. Understanding and walking through the process impacting significant accounts. I will now tie up some part in the planning because these are a bit fragmented in terms of the documentation. Now getting back to where we were, right, planning the scope of engagement. Typically in a statutory audit there is this phase, thanks to the giants of this profession, SCA and SCOT, SCOA, significant class of accounts and significant class of transaction analysis, right? Understand it this way. What is an audit? An audit is an exercise where you give an opinion on the true and fairness of the financial statement. Now what is true and fairness? True and fairness is a stature on the financial statement position where we feel there is no material misstatement. Now what is material? Material is an amount beyond which if there is a misstatement it vitiates the stakeholders' capability to take a decision. Now in the context of all of this, the audit should now start getting focused into seeing areas that are material. Okay, that is the sum and substance of it. But what we are being trained, 1700 rupees tally alna koda client put an MB at 1700 rupees we will make him tally. No, that is where we come, because for us accounts is more important than audit, right? So we will make his accounts be absolutely perfect by identifying the smallest of mistakes. In the context of a real world expected audit, materiality plays the most important role. You identify materiality as per the standard, then you go about doing this exercise called significant class of account analysis. Ideally take all the financial statement line items, put it in an Excel sheet, find out your materiality, see what all items in the financial statement line item crosses the materiality threshold or is nearby about to the materiality threshold, and say that they are the significant class of accounts. Now once you know that these are the significant class of accounts, then comes the significant class of transactions. No longer company's account transactions, they are process driven. There is a process that leads into accounting multiple transactions, a process called revenue to receipt, that accounts for sales, that accounts for debtors, that accounts for collections, that accounts for bad debts, that accounts for discounts, that accounts for commissions, so on and so forth, right? So every item in the financial statement in a combination can get tied up to a process, which is what we call significant class of transaction. Revenue, debtors, commission expenses, bad debts, all these together comes together into a class of transaction called revenue receipt. So this line, this understanding and walkthrough of processes impacting significant accounts, is that once you know these are the significant accounts impacting the financial statement, once you know that this is the process that is impacting all these accounts, you do a detailed walkthrough of the process in connection with this. Now going into a going into the bank audit scenario. Typically in a bank, almost all accounts will be significant because the materiality in the context of the bank will be much smaller to the size. Then you go about understanding the SCOT or the process for each of those financial statement line items. Then you understand the process. You go to the loan processing unit, understand the entire process of sanction, appraisal, sanction, disbursement, monitoring. You understand all these processes, you document that. Then you go to the deposit segment, understand the sourcing, then all the KYC around getting a deposits, then deployment of those deposit funds. Then you have the general finance department, then you have the HR department, then you have the investment division. All these divisions which are typical to a bank, you go about understanding the process. More importantly, in a bigger bank, head office and branch is in itself is a big process to understand. You understand all of it and you document, right? That is what this phase about understanding and doing and process walkthrough of processes impacting the class of accounts. Identifying significant risk, fraud risk and the risk of material misstatement and plan to address the same. Now jumping back to our story, we have understood the entity. Basis our understanding of the entity, we have devised something called the materiality. Basis the materiality, I have now identified the significant class of accounts. Basis the significant class of accounts, I have bundled them into significant class of transactions. Now after doing the significant class, bundling them into significant class of transactions, I have done the process walkthrough to understand the internal control environment, that internal control environment which we discussed earlier. Now once you do all of this, you are expected to get the faith on the control system of the company. So which means, okay, in the area in the control, these are the controls that are there. So which means whether they have a robust control environment or whether they don't have a robust control environment, all this gets identified. Basis all of this now forms the fulcrum. SA 315 exercises in SA 300 and 320 forms the fulcrum of the most important exercise in an audit called the risk assessment phase. So by which time itself we would have completed some 8 or 10 days into the audit, and then starts the phase called risk assessment. You only imagine the risk assessment document as a matrix. Your financial statement line item, right, the P&L and balance sheet, and the assertions. Somewhere in our standard we would have heard of the word called assertions. P&L item abdina cut off, accuracy, occurrence, and if you come to balance sheet, rights and obligations, accuracy, valuation, things like that, right? All the financial statement line items spread across the respective assertions as a matrix. Okay, now with your fundamental behind the control environment of the company, about the industry, about the class of accounts, about the way the transactions are happening, you go about filling the risk assessment matrix. Meaning, no, this is not what could go wrong. I think of course I didn't go to auditing class, but I understand one of the most teasing questions in auditing is what is the difference between inherent risk, control risk and detection risk, and the mathematical phenomena behind these three, right? This inherent risk assessment sheet is about understanding what is inherent risk, right? Understanding the inherent risk of misstatement of the financial statement. Meaning inherent risk means possibility of mistake, risk that a financial statement is materially misstated, assuming there are no controls. That is what an inherent risk is about. More often than not, in this phase they will say, sir, avana pathi theriyada, ஏன்னா தப்பா தான் போடுவான், அதனால ரிஸ்க் போடுங்க. That is all control risk. Meaning a control not being followed is a control risk. In an, yes. Yeah, assuming there are no controls. Yes, sir. Sir, can you give an example on the financial side, sir? In a financial transaction, can you give an example where? Correct. Control risk. Correct. That's what. So inherent and correct. That's assuming there is no control. Standard word is inherent risk is the risk of material misstatement, assuming there are no control. Meaning, by the mere nature of the transaction, it is a complex transaction. Yes, sir. Okay, sir. So what? Okay, sir. So in the context, what I am saying is the transaction is of that nature that you cannot expect a control there. It is a very complex transaction. It is dependent on outside data, things like that, right? Yes, sir. Okay, sir. So things like this, I will put maybe beyond the hands of the company if we have to understand it in a different manner. Typically, if you go to know the standard, we started with the concept of appendix, right? Appendix to the standards on auditing, in fact, gives instances of inherent control weakness itself. Okay, they can be taken as an attribute in itself. I think there are 18 or 19 instances which are considered as an indicators of inherent risk, right? Those indicators, if we feel that financial statement line item has any of those indicators, dependence on outside data, non-competence of the person handling that part of the financial statement, past errors observed in that area of the audit, new transactions that have happened in the company, multiple nature of transactions getting accounted in a single ledger, which is the most common in banks. Anyone who has got an opportunity to see the bank financials, there will be items called miscellaneous income and miscellaneous expense, where typically 80% in terms of number of transactions gets accounted, not in volume. In terms of volume, a lot of it goes into interest income and interest expense, but there are these miscellaneous income and miscellaneous expenses where everything that is not interest or commission gets accounted. So things like these where entries come and get posted from different places are all assumed to be items of inherent risk, right? So this inherent risk assessment, in fact this risk assessment, though the word commonly used is risk assessment, it is not risk assessment, it is only inherent risk assessment. All that an auditor is expected to identify is inherent risk, basis is understanding of the control environment. You go about and saying, okay, in sales there is no problem except for cutoff, in other cases there is no problem, but cutoff alone I think there is an higher risk. Like this, multiple financial statement line items and multiple assertions, you go about fixing the risk as high or low. There is nothing called medium actually. There is a high risk or a low risk that you go about fixing here. Now once you identify that there is an inherent risk, you go about substantiating whether your inherent risk moves into the significant risk category. Now moving from inherent risk to significant risk is typically a mathematical formula. Once you know that there is an inherent risk, you need to see the likelihood of the risk happening and the magnitude of the risk. If the likelihood of the risk is more and the magnitude is perceived to be material, then that risk becomes a significant risk in the audit. So now we'll only extrapolate the imagination of our matrix. Our matrix is FSLI, all the assertions, high, low, 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 medium, so a place where to fill that high, medium, low. Then the next column called whether it is a significant risk, where you will say whether the likelihood and magnitude test, it is an AND clause, likelihood and magnitude. Sometimes likelihood or magnitude cannot be perceived, in which case it is assumed to be high. You identify based on the likelihood and magnitude whether it is a significant risk or not, right? Then comes a column called fraud risk. Once you, fraud risk alone happens in a two-way marriage. Once you feel there is a significant risk, you may have to see whether there is a fraud risk. Not all significant risk may necessarily be a fraud risk. To see whether it is a fraud risk, you need to see whether there is an opportunity, incentive or a rationalization. Meaning, in your understanding of the control environment, in your understanding of the inherent risk, do you think there is an opportunity for a fraud to happen? A mere opportunity might make it a fraud risk. More often than not, an incentive. When you did your walkthrough and when you did your understanding, you observe that the client is saying to you, sir, so in our company this is the sales process, sir. Our marketing team goes about fetching the orders. Once the order comes, there is a machine order placed. Basis the machine order, our plant will manufacture, sir. Basis the manufacturing, our dispatch team will do the dispatch, sir. But the most important thing you see, sir, if we do a zero stock at the end of the year, we get a gold coin. So which means there is an incentive. There is an incentive to do a zero stock at the end of the year, right? Which means there is an incentive to do a fraud, incentive to do something wrongly. So what can happen if it is an FOB sales or a CIF sales based on the INCO terms? The company might not comply with the INCO terms and account for a sales and make the inventory zero. So when you know through your understanding of the control environment that there is an incentive to do a fraud, you decide that there is a fraud risk. Whenever there is a fraud risk, significant risk is automatic, but not other way around. Now delving deeper into this fraud risk, if you go through SA 240, there are three places where fraud risk is a rebuttable presumption. It is assumed that a fraud risk exists. One is in revenue recognition, the next one is in management override of controls, and third thing is related party transactions. In all these three places, it is always assumed that there is an fraud risk. So now only further extend your chart, extend your template, IR, all the the financial statement line items, all the assertions, a column called whether it is significant risk or not, a column called whether it is fraud risk or not, where for revenue, management override of controls and related party, you always fix it as yes unless rebutted otherwise, right? So in this whole gamut, typically you need to go about documenting why you say something is called an high risk or a low risk. If you are saying it is an high risk, then decide whether it is significant risk or not. Then depending on whether it is a significant risk or not, decide whether it is a fraud risk or other way around. If it is a fraud risk, it is an automatically significant risk. Now if you do this complete documentation, this is where your risk assessment phase in an audit typically is expected to get over, right? Now you imagine an AQMM context. In an AQMM context, all these are the templates that you build for your firms to start using, for your teams to start using. Then after this identifying significant risk, fraud risk, I am only waiting for the audit strategy to come elsewhere. It is there. Okay. So incidentally, these analytical review procedures normally are always done at the end of the audit, but as per our current standards, the earlier AAS, auditing and assurance standards, were not like that. Now in the current standards on auditing, there is an expectation to carry out an analytical review even before the starting of the audit, meaning you have understood the control environment, you have understood the business, you have understood the market and everything, but still you do an analytical review procedure to identify the offshoots, to identify one-off transactions, to identify the trend. You will feel the pressure when you do an analytical review procedure. You already see that compared to last year, the costs have increased, the turnover has reduced, the profits have reduced. So which means you already start with the skepticism that there is a reason for an aggressive accounting for the company, right? That is why this analytical review procedure is there. Again, in our template imagination, you can only imagine a template which will say current year, previous year, or previous year multiple quarters, do a trend analysis, document the analytical procedures and conclude that these are the fallouts of my procedure. In a bank, getting into trying to combine the risk assessment phase and the analytical review phase. In the risk assessment phase, typically in a bank, unlike in all other entities, in a bank and financial institution, revenue recognition is never assumed to be a fraud risk, because no bank or a financial institution will runs behind that interest income. They run behind the loan itself. So there the fraud risk exists at the loan level itself. Two types of frauds: one, giving a wrong loan, siphoning of funds, giving, not having a proper sanction, putting personal interest over the bank's interest, things like that. Second is wrong classification of the loan, where it will be a non-performing, they will end up marking it as a performing. Thanks to RBI's regulation in 2021, which made it mandatory for an automated tagging. But beyond that, unfortunately, as auditors, we are expected to take care of qualitative tagging of NPAs also, in addition to quantitative tagging. So which means, basis the DPD, due days past default criteria, system will identify the NPAs, but the qualitative NPAs, meaning sir, they are in an industry in which Indian government has already put a regulation, which means this company is now heavily dependent on imports from China. The Indian government has placed a bar on the imports from China, and this company does not have an alternative, and it has pledged, the working capital is solely based on the future forecast. If import itself is not possible, how it will export? So which means this loan is bad. Now that kind of an qualitative analysis and identification of an NPA rests with the auditors, right? So which means, in a bank's context, the revenue recognition is normally not seen as a significant risk. It is the whole loan and the asset classification itself that is seen as a significant risk or a fraud risk. There is an inherent risk that exists in 4 items: miscellaneous income, miscellaneous expense, other assets and other liabilities, because so many things get dumped there. If you see a bank's balance sheet, it is hardly 6 items. Unlike a company's balance sheet, which is like an 18 or 19 items, a bank balance sheet is very crisp, because a lot of crap remains there. So these items are the inherent risk and significant risk that you will have. Normally your documentation will kind of read to it. Analytical procedures in the banks are very easy. You identify certain key ratios, like the you identify the NIM, the gross NPA, net NPA ratio, CRAR, certain key ratios, and the movement of these key ratios, and how comfortable these key ratios are moving will kind of give you an understanding as to how the bank is functioning this year. Next one is working on materiality, performance materiality, and tolerable errors and its basis. In the sequence, this has already happened in our story of an audit, but typically your materiality template should be like this: what benchmark is chosen, PBT, revenue, any other item. Why are you choosing this benchmark? There has to be a justification to it. Having chosen a benchmark, what is the percentage that you want to weight, that you want to adopt to? What is the percentage of that you want to take as an material amount, and why do you want to take that range? This is the materiality computation. Now coming into AQMM, you need to have a format for your firm which spells this out, which says, for these kind of industries this will be the benchmark, for these kind of industries this will be the benchmark, and for these kind of industries this is the percentage of this benchmark that you need to take. Like this, you need to create a dictum for any audits to adopt. Now that is what is that AQMM has brought. Earlier materiality was always assumed to be a judgment. Now no longer materiality can be just a judgment. It has to follow out of a protocol of the firm. So if in your company, in your firm, there are 8 or 9 audits, all 8 or 9 audit goes through the same materiality template, and depending on the industry where they are, and depending on the benchmark that is being chosen, your team decides what is the benchmark and what is the percentage that is adopted. Planning, performance, and trivial. Clearly trivial, I think is very obvious. Planning materiality is at the top. Performance materiality is because you do an account level work, and then comes clearly trivial, which is items below which if there is a misstatement you won't even aggregate. So these are the 3 numbers. So typically your materiality in fact is day 2. Day 1 is about all your SA 315 exercise, understanding the entity and its internal control environment. Then comes materiality, because one of the key items in materiality is the benchmark identification, which is that number which all the stakeholders will look into this entity. For a bank it might be different, for a normal manufacturing company it might be different, for a startup it might be very, very different. So depending on the nature of entity and the nature of industry, you go about identifying what is the benchmark that the people will be looking at the financial statement and make that as a materiality. So materiality is much earlier in the life cycle. Then testing strategy and determining nature, extent and timing of audit procedures. This is the moot point. After our inherent risk exercise, this is the next most important part of your audit documentation. This audit documentation typically gets itself titled as an audit strategy document, which means all the financial statement line items where you identified that there is an inherent risk and a significant risk, or just an inherent risk, or a fraud risk and a fraud risk, in all combinations, you will gather all those financial statement line items, and you will then again reiterate the fact as to what is the risk, whether it is significant or not, whether it is a fraud risk or not, and then write how are you going to go about auditing this. You need to write your audit strategy. So in the example that we spoke, where the company has an incentive to give gold coins for zero stock, we will assume that to be a fraud risk, and for the assertion called cutoff, and you will write, okay, these are the audit strategies, these are the audit techniques that I will do. I will physically be present on 31st of March in the factory and ensure the last sale invoice tallies with the last lorry out. I will see the security register and I will confirm. Now this will be the audit technique that you will decide, right? Now the reproduction of this fact is this audit strategy document. So typically in an audit strategy document, you start with the regular things about the company, blah blah blah. Then you write, these are the risks that I have identified and these are the audit actions that I will do. It does not stop here. It does not stop here, right? Then you go after this. For the significant risk and fraud risk, this is the audit technique that I am going to do. Other than this, for all other items, this is the test of control. These are the controls that I am going to test. This is the substantive audit procedures that I am going to do. Abdine, we will have to reproduce our entire audit program, typically that. Other way around, whatever is the audit program that you already have, bring it here and write it suitably, so that in the sequence of an audit your planning becomes complete. Now in an AQMM context, that happens at a firm level. Your firm will say, for these kind of significant risk, the most expected audit actions are these, the most expected TOCs are these. Other than that, this is the kind of substantive procedure that you will have to do. This is the kind of test of controls you need to do. Typically in our size of firms, what we should write is, this is the sampling methodology that you need to adopt. You need to verify so many percentage of items above performance materiality, so much percentage below performance materiality. Like this, you need to put the framework for sampling that your team has to follow, and typically your team picks out the audit strategy from that framework that you lay down, right? Now here you will go about writing for what all items you will use an confirmation strategy, for what all items you will do a physical verification strategy, for what all items you will do a recomputation technique, for what all items you are going to adopt an expert. Like this you will be writing item by item. Typically all auditing standards, whatever is the, if you go to the index of your standards and auditing book, there will be the heading, right? You will write the heading and you will say how that heading, how that standard is going to be applied in your audit. External confirmation, using the work of other auditors, using the work of experts, and then physical verifications of inventories. All these things get reproduced there, and you go about writing how you are going to adopt that technique in your audit. You will write the extent of testing, you will write the timing of testing, which of it is surprise, which of it is not surprise. All that is written here. For a moment we will pause and go to our original story, right, where we discussed when the regulators look at us, the regulators will look as to whether you have completed the regulation. Now the regulation says you need to devise your audit strategy and write it in such a way that in your mind the risk is brought to a lowest level. Assuming for a moment, in the gold coin example that you are writing, you have not written this audit procedure, right? As an engagement team you did not write, the engagement partner also, and you write some other audit procedure. You say, I write a letter to the party and I confirm whether the goods have reached to him before 31st of March, something like that you write, and then you conclude the audit and the fraud is identified, and the regulator comes in and he asks, as an auditor, you should have sat there on 31st of March and you should have seen. Why haven't you seen? Now, can he question like this? Unfortunately, no, he cannot question. That is what today's regulation is. Once I define an audit process, if I don't do an audit process, I can be questioned. Now, what audit process I adopt is my own decision, and the regulators cannot get into it. And there is a famous Supreme Court judgment where again this matter is being reiterated and said, wrong judgment on behalf of the auditor does not mean negligence. He thought something else. He did that, but something else happened. He was expected to do something, which means in our audit procedure we write that I will be physically available on 31st, and if you don't do, no, that is a non-compliance. So which means this writing of an audit program, this writing of the audit plan or the audit technique that you are going to adopt is of paramount importance in the context of facing the regulators in the future, right? Most ideally, the best practice would be to create a detailed program running across all the areas of the audit in the firm at an overall level and make that as a standard pack to be adopted at every audit that is being done. In the audit strategy, the teams can simply write process as per the firm's pack will be followed. For the significant risk and fraud risk alone, you write the additional audit techniques that you want to use. So this would be the typical process you can do. Team planning meeting and its minutes. Teams and all, what is simply say? We say go and do the audit. That is the only instruction we give. But then you need to know minute. So in your audit workflow, you can have pre-audit meeting minutes, then bi-weekly meeting minutes, then partner review meeting minutes, meeting with the client and its minutes. So all these things has to get minuted. The best and the easiest way is to always have online calls with the teams and the client and always record the meeting or put some AI to create the gist of the meeting. Even if you both are sitting like this, better to do it as an online call. That is the easiest way to ensure all the bloody meetings get documented. Else it is only humanly impossible for us to minute every meeting and write, because in a same day we will meet the same client at least 8 or 9 times. Right? So it is not possible. So best habit is put calendar invites, go and sit physically, switch on that meeting, both of you can connect, talk, and the meeting will automatically take notes and it will give you the gist which you can save in your file. Same way the team meeting also can always happen like that, and all this can get minuted into your audit notes. Allocation of work and timing of execution and review, it is only progressive. You create an audit strategy. In the audit strategy, you write what are all the audit steps that you need to do. Now each of these steps get allocated to someone. They are given a target date to complete. Then someone is kept as a reviewer to do that work, and someone does a review of that step. So all this gets properly documented. Going back to the bank audit story, in a bank audit, as we discussed, classification of loans is taken as an item of a fraud risk, and all the miscellaneous income, miscellaneous expense, other assets, other liabilities are taken as items of significant risk because of the inherent risks that are being there. Normal audit procedure for that would be extending the sample in respect of loans, doing an independent systems audit of the automation that has happened on the IRA classification, wherever necessary do a field visit of the project in case of project finance, doing external confirmation in cases of loans to ensure that there are no fictitious loans that are booked by the bank to increase its asset size. These are typical audit strategies that you can do. For the miscellaneous assets, miscellaneous expense, miscellaneous income, other assets and other liabilities, same thing, extending the sample for verification of the transaction, finding out wherever possible, taking external letters and matching, like say all the NASH mandates, all the digital banking transactions, all these things, there will be an external party from whom the transactions are pushed. Ideal way would be to get a balance confirmation from them and ensuring that the transaction tallies. These are some techniques that gets noted. And when we go into the allocation of work, normal way would be 60% of the teams will work on the loans, balance 40% will work everywhere else. Other way around, if it is an audit that needs to get over in 4 days, which is what the banks want us to do, everyone will do only loans, as if nothing else exists in the balance sheet of a bank, right? Which is not right. Typically, you should ensure that you allocate at least 40% of the total time to other areas. No longer banks do frauds in loans. It happens everywhere. So possibility of misstatement lies in multiple places because today's digital transactions are so voluminous. banks themselves don't know from where the transaction comes and where the transaction go. It is all taken care by RBI, it is all taken care by this entity called NPCI. All these entities are now posting entries into the bank's ecosystem. So banks alone don't have control in these transactions. So when we are auditing such big animals called banks, might make sense to involve experts of IT knowledge, might involve experts who have knowledge about valuation of land, valuation of plant and machinery, etc., for you to understand the veracity of things that are there. Outcome of test of control including IT environment, IT general controls, IT application control, and determination of substantive testing. IT and all we have not tested in our kind of audits the way we have done. IT testing and all is not something that is understood, but it is expected. Simply our own institute has a very good checklist for carrying out audit of ITGC. Run that checklist by the client, get a confirmation of their complaints, wherever possible do a small testing of what they have told, and you kind of close it. Whatever we earlier noted down as an audit plan or a program in our audit strategy, push it to its logical conclusion in the form of an work done report, and note down the findings in a common place, which is where a normal problem comes. Our teams will write the query in WhatsApp, our teams will write query on the backside of a paper, somewhere in a notebook, some queries will be in the mail, some queries will be everywhere. When a peer reviewer comes, when you open a file, there will be a query that will not get scored off, there will be a query which would have never been asked at all, there will be a query somewhere in the WhatsApp chat, and so many things. So create an interface for the firm or a format where all the queries are noted, and only from where the partner review even starts. Partner starts reviewing the team's query sheet and ask questions out of that, rather than நீ பாட்டுக்கு உன் வேலையை பண்ணு நான் பாட்டுக்கு என் வேலையை பண்ணுறேன் அப்படின்னு பண்ணாமல் we audit what our teams audited. That is the best way for us to save ourselves. Sampling basis, which we already discussed. Typically sampling basis is a firm level protocol. Firm says in our firm this is how you do random sampling, this is how you do judgmental sampling. When it comes to random sampling, this is the matrix at which the number of transactions get tested depending on the risk of the financial statement, depending on the reliance on control that you have, a dictum at the firm level which gets followed at every audit level. Preparing detailed audit strategy document including instructions to component auditors. SA 600, thanks to Nafra, this is now the talk of the town. So audit strategy which we discussed earlier is what is again explained here, where you prepared a detailed strategy on how you go about doing the audit. You go about issuing instructions to the component auditors, or receive instructions when you are the component auditors and do the needful. Substantive audit procedures adopted and performed for each item of BS, operating income and expenses, which is what we discussed in detail. It is very, very critical that you write your audit program in detail and say these are the steps that you need to follow. Gone are days where the regulators get inspired by the experience of the auditor and say, sorry, you experienced auditor tappu panna mattinga. No longer it is like that, unless you are able to showcase what has happened in the form of work paper, which includes things like this. It is humanly impossible to expect that the regulators will not catch us. So this audit program, compliance with audit programs and all becomes very critical. Audit procedures, where we were in audit procedures planned and performed to check the appropriateness of going concern assumptions. All this part of the audit strategy only. Audit procedures plans and performed to check the subsequent events, checking of completeness of related party, IFCO for internal control over financial statements. So for all these things, audit strategy will have a single liner. Following that, there will be a 1 or 2 page checklist for every single item. That is how sequence of that audit pack should be. Procedure to verify journal entries and check the authenticity, contingent liability covering nature, management procedures for identifying, etc. Using the work of experts and internal auditor. Till this we already discussed in our audit strategy documentation. Then using secretarial compliances, accounting policy checklist, schedule 3 checklist, CARO checklist, checklist for accounting standards and Ind AS, checklist for standards on auditing. All these things are very tough to comply. Why? If you take an Ind AS, normal Ind AS will have anywhere between 70 to 75 paragraphs. If you are unfortunate in handling Ind AS 115, it has somewhere around 314 paragraphs. So your checklist as per ICAI's regulation is expected to replicate all these standards para wise, and for the teams to confirm if every para is done. Avla madam did. It is not possible to do it, but there is a different way. How? You write your audit program or the audit processes in such a way that it answers all these things. You know where our teams get irritated, you give them a detailed program of say 500, 600 steps to complete each area and then ask them to fill an 1000-line checklist. That is where the problem is. If the audit programs are self-constructed in such a way that they respond to the expectations of the standards, then filling the checklist is only a fallout of it. People can go and rationalize and think. In our example, assuming there is a line item which says verify complaints with GST input credit in case of additions, right? If the team had done the audit procedure, when they come to Ind AS 16, there will be an item, refundable government payouts shall not be considered as part of the cost, whether the company has complained. Now this para and that audit procedure is what is marrying each other. Here our team will automatically go and say, yes, they are taken care because I have already done the audit procedure. Problem is, after audit getting over, when they fill the checklist, they identify that this is something they didn't know that they have to do. Componentization of cost, capitalization of interest, right? Put to use, ready to use, difference between put to use and ready to use, all these complex things. In the standard it will be very complex, but when you put in practical application it is actually very easy. So the best way is to write a program which takes care of practical application of these standards, and when you go to checklist it is about yes, no, not applicable. Our teams yes, adin potu poiduvanga. Reverse is tough. You just put a program, say verify additions, verify deletions, recompute depreciation, take physical verification report, check title deeds. If your fixed assets verification program is 6-liner and your checklist has 120 line items, it is not possible. Right? Better write your program differently. Check additions. While checking additions, check add items that you want them to check. Deletions, add items that you want them to check. Now when they fill the checklist, it will be so obvious. Oh, okay, this is there, this is there. Oh, for that only this, for that only this. So this tying up of the program is the most critical part. Now we can think why AQMM is important, because it is now at the firm level. It is no longer at an engagement level, right? So you write at a firm level a one-time exercise to put a detailed program across all of this, and then it is all obvious. Teams go, they pick, they do the work, they fill, and then they close. But the ideation at the firm level has to be very strong to be able to do it. Certificates in accordance with ICAI guidance note, which is that guidance note that I was discussing. Engagement quality control review process. All firms it is suggested to have it. EQCR need not be an outside person, it can be someone within the firm. It is one another person other than the auditor himself. Two partner firm have the other auditor. In fact, EQCR need not actually be a partner of the firm. So long as he is a chartered accountant, it is enough. That is what the standard says. So if you have some chartered accountants who are not involved in the audit, they can also actually be the EQCR. There is no problem. But the problem here is the ego. That is the biggest problem that our people have with EQCR. But if you go beyond that and think it as an expected thing, then EQCR is a much needed exercise. The EQCR also same way. At the firm level, you can decide what and all an EQCR is expected to review, create a checklist around it. Every time an EQCR does a review, he fills that checklist and gives a confirmation that he has done the EQCR work. Then management representation letter. Problem is this management representation letter. If you have a format, no, that becomes a problem. But you have to have a format because our clients don't have a format. So this management representation letter, making it an habit to take it before the date of signing the financials and not when the peer reviewer comes, is a most important thing that we all will have to learn and adopt. Then the summary of uncorrected misstatements, schedule of unadjusted differences. These are all part of closure of an audit. Analysis of actual and budgeted man hours. Financial analytical procedures. Closure and archival of files. Any other format checklist and templates in connection with the audit. SAB LODR, more specific to an engagement. Companies Act complaints specific to an engagement. Right? ITGC, audit trail checklist in connection with an engagement. These are some specific checklists that you can decide for your firm, build for your firm, comply when you carry out your auditing process. This archival is our filing in our understandable language, is archival in our alien language. The archival is typically a sum and substance of all the work that you have done in connection with an audit. If you take NAFRA's report, they target this archival file, and that is where all the questions are. Board meeting date is this, but the archival file has been touched upon so many days after the closure of board, so many new files have added to this. So which means we need to now think of creating an interface or a structure by which all the checklists, processes, procedures, everything happens, and they subsume into a file. At the same time, it does not get tampered, it does not get hampered on, it does not gets added with new files by someone else. There is in confidentiality and everything. That is where the digital competency will come. That is what we will very briefly touch. I mean, I don't want to dwell more into that. This itself is already heavy for us to digest. But the digital competency is about creating a technological capability of everything that I discussed thus far. Having an environment from where people can go and pick out formats, having an environment where the formats can prepared and get uploaded, having a way in which the file can get archived, having a process by which it can be confidential, having a process by which it can be reviewed upon, having a process by which it can be stored. All this is what is covered in the digital competency guide. And who will be able to handle this amount of work and these kind of digital is the human resource. So which is where the human resource area will come in. The last point is more critical. A lot of times, I think in my own firm this has happened 4 or 5 times before. A huge exercise will be taken, one full month will be spent in creating the checklist, and then for the next 3 years no one will even touch it. It cannot happen like that. All these forms, checklist and everything will have to be reviewed year on year for any updation that has to happen, and there is a huge effort that goes on in able to creating that. Next one is on human resource. I will deal only with this slide, I will not go anywhere else. Policies and practices, a well laid out policies, practice. I think typically whatever we expect in our client in terms of an HR is expected to be here, where we write about what is the recruitment policy, what is the training policies, what is the retrenchment policy. All those things have to come in. Resource planning and monitoring, which resource has which capability, what is the life cycle of the resource, what he will learn in year 1, what he will learn in year 2, what he will learn in year 3, what will be his roles and responsibilities. All these things has to get written down. Employee training and development, a whole lot of spend has to happen in training and developing them, and they have to be properly monitored. I still know when a peer reviewer asks about minutes of training, that day something gets written and given. Instead of that, periodical training program. Best way again is to create online meetings, record those meetings and keep, so that in future all that we may have to give is the recordings to our reviewers. Resource turnover and compensation management, increasing the compensation when the turnover increases the standard culture. Rather than doing it, having a proper career path, having a proper leadership path, telling them what they will become when and how they will be compensated at what point and what is the extent of compensation and all. In that, somewhere in the HR and all, he will write your compensation should be pegged to the quality of the firm, which means you should write the compensation package in such a way that if they abide by the quality control policies, which is the AQMM is whatever we are discussing, the better they comply with it, better will be their pay. Which means the AQMM says to what extent are the compensation pegged to the quality of the resources, including that of partners. Partners getting paid for business brought in, partners getting paid for retention of business is one way, it is also relevant. More relevance is the fact that partners getting paid for proper compliance of firm's policies, archiving the file within the 60-day timeline, signing off before the board meeting date, following all the processes and templates, training their staffs for the minimum number of hours that you want to lay as a protocol. Like this, creating an KPI or a KRA, telling specifically how their performance will be valued, and to the maximum extent possible, pegging this performance with the quality, which in turn is pegged with this AQMM. Right? This is the cycle in which all this has to get tied along. Qualification skill of employees. What kind of skill sets are needed to do what kind of audit? Before getting into an audit, make them do that 1 hour, 2 hour online programs on things relevant to that audit, rather than making them go blank. All these things typically are getting covered. Hire one HR consultant, give him the requirement, make him put together a policy, start complying with the policy. That's the easiest way to do this, because earlier is at least audit, it is something that we understand. Human resource, handling our own self itself is difficult. How do we handle our bigger teams? Best way is to hire someone, make them build all the policies. By now there are so many HR people in the market who are saying, sir, audit firm HR policy நாங்க போட்டு தரோம் சார், ஏன்னா எங்கள்ட்ட template ரெடியா இருக்குங்க சார். So there are people like that who can come and say, sir, that and all I know, quality picture. So you don't worry sir, I will give you policy sir. So there are people who can give you clear policies aligning to CA firms, find out that, put that as an matrix. The tone at top should be very clear. Partners also get paid based on quality, staffs also get paid based on quality. Quality is the paramount importance. This is the tone that is expected to be set. We will go to digital competence, with which we will kind of close today. So this is the digital competence, but still we will read it out. Managing digital identity, IP secured, password secured, users access control rights are there in the system, users access control rights are there to touch the server, all this, sir, their own laptop, their own calculator, nothing the firm is providing. How do I expect to do these things? Correct da? BIOD, bring your own device policies should get framed. Even if it is their own laptop, till their life cycle with the firm, get into an agreement with them that that laptop will abide by the firm policy, and the firm has every right on to look up of the data into that laptop. To that extent, do an, if I don't know what is the kind of architecture our firms operate, do an IP match or a MAC ID match basis which only they can do certain things like that has to get created. Operational process automation, whatever we discussed so far, all this has to get an automated, expected to be in an automated process. Centralized file storage, these days it is very cheap. Application of invoicing and receivable management, redundancy and continuity, laptop and data security, copyright and licenses. All the licenses that we have should get stored and documented. That is where we will get stuck, because all of us are using a home version, none of us are using business version. You will use a home version, document it. Tomorrow Microsoft person will do a surprise audit and he will levy a heavy penalty. The difference between a home license of an Microsoft and an office license of Microsoft is 1890 rupees for 6 licenses. So it will make sense for us to enroll as entrepreneurs into the Microsoft environment, get a business license rather than a home license. Same way with the OS also. Home OS to office OS is slightly costlier per laptop, but might make sense to use an office business OS rather than a home OS. Protecting personal data and privacy, information systems related audit and reviews. Depending on size of firm, do an IS audit of your firm once every year. Design of application level controls, whatever applications you are using, who uses what, the usual user access rights. Custody of digital assets, availability of quality resource pool and talent development relating to digital competencies. Hire a small IT team or outsource an IT team which takes care of all of this. Again, adhe HR all mari idukku aalunga irukanga sir, CFO ma na varen, all irukanga, find them, outsource them, give them the responsibility to take care of this. Availability, level of automation relating to audit processes and nature, whatever we discuss as checklists and things, what is the amount of automation that can come in. Adoption of advanced and emerging technologies. All this is that which is AI, ML, blockchain, so on and so forth. With this we kind of come to an end to this session. Technically beyond the audit for the HR management and digital competence and all, there is no tie-up with bank audit. It is relevant across everything. And kind of subsume and bring it to an logical conclusion. This all revolves around the fact of setting an protocol and a process for firm as a whole. The process has to be top down and not bottom up. As I said, whatever we are doing currently, fresh. Okay, these are things needed, these are things needed. Best way is to start with the checklist that I was talking. Once that is ready, that is the bulk of the meat that you need to eat. So put together all those things, then the principles and fundamentals beyond that can start over. In fact, once you start writing that, the sexiness of the document will keep increasing and you will find more interest, and you will build a manual for your firm, like your firm experience or whatever is the name. And you say, once you enter into the firm, you give that to the new joinee, they go through that and they understand. There are good products in the market which can actually take care of all of this. Good products with reasonable prices are all there. Better will be to adopt. Of course, adopting them blankly is also a problem, because without knowing what you are getting into, you will end up getting into. Do an exercise, do an like an 1 week or a 10-day brainstorming exercise amongst your team to move our firm to point A to point B in terms of the maturity. Moving from point A to point B, and in due course of that movement, find out what all is needed, find out products that are available in the market, see how those products are best suited for our firm, start applying. First year will be very tough, second year will be very, very tough, because first year goes in enthusiasm. Second year is when people will start questioning, sir, I don't find why I should feel all of this, all these questions and all will come. Third year, acceptance will come. So never it will become easy. But then once the acceptance level comes, it is only in a repeat mode. By which time AQMM 3.0, 4.0, 5.0 will come, that we will handle in some other session. But irony of the day is this, right? We need to go beyond the fact that I am very comfortable with what I do, to I need to showcase what I am doing. Now the showcase, earlier showcasing used to happen in a manner. Now we have a guiding lamppost telling you how you have to showcase what you know, right? It can't get better. It can't get better than it coming from the horse's mouth, the alma mater itself, telling you, boss, you please have these things, you please exhibit these things. So long as you exhibit all these things, we are very happy. We have done it in our organizations. We have seen the quality improve tremendously. Beyond all of this, our teams will start thanking us for what we are doing to them, because in due course of doing all of this, forget the fact that we are compliant with ICAI and all, what we end up doing is we get ourselves imparted with a lot of knowledge, and more importantly, whatever knowledge comes into us, we end up sharing it with our teams, right, who are typical futures of this profession. And when they understand that our firm is operating at a quality and our firm is giving us certain things, irrespective of the size of firm, irrespective of the number of staffs you are dealing with, they will definitely be thankful, because when they come to these, I don't know what it is, GMCS or whatever management training programs, when they come, when they sit in a chair next to with an big firm's article to our firm's article, if they feel the words that they talk and the things that they know is something that their firm has also done, they will be immensely respectful to their principal, which is us. And that is the real pleasure that we will get in doing these kind of mass exercises. Client will not pay a single rupee more for the entire efforts that we have taken. Still okay, we will get a lot of intangible, we will get a lot of goodwill. Our client will become the CFO, or they may even become finance minister. When they become so and so, they will get back and do whatever is needed to us. Thank you all for the patient listening. I am very surprised that the audience has still stuck here. So I am more than happy to get into any discussions or questions. I don't think these areas can have a doubt. Whatever is there, I am more than happy to discuss with you all. Thank you.
Today's session was a very interesting one, and definitely we all have taken some new things which we have not done so far, and which we are going which the institute expects us to be better down the line. And I thank Mr. Sanjeev Aditya, who has taken a lot of pain to help us to understand the subject, and we look forward for more sessions down the line. Thank you. Bye.